Every collapse in history, whether it's an empire unraveling, a financial breakdown erasing millions, or a society hollowing out from inside, follows the same formula. It's so consistent that it feels like watching the same storyline replay across centuries. The sequence never changes: a long, quiet buildup, a sudden break, a surge of disorder. And right now, one major economy is moving through this pattern far faster than anyone anticipated. That economy is Russia, and its internal financial deterioration is a warning to investors everywhere. This isn't about tanks or missiles. It's a quiet, punishing process of economic self-damage. A leadership line making decisions that undermine its own citizens, its own businesses, and the country's long-term trajectory. The central warning: the Seneca effect. While the West is absorbed in political and cultural noise, Russia is flashing alerts at high speed. Analysts call it the Seneca effect, named after the Roman philosopher. It describes a simple pattern: growth is slow, collapse is fast. You ascend the mountain over centuries but fall off it in just a few years. History proves it. The Roman Empire, the Ottoman Empire, the Soviet Union all took centuries to build and only a handful of years to unravel. The core truth is this: systems erode gradually and break suddenly when the middle-class binding fails. And Russia is showing the same signals right now. The collapse sequence: 5 financial indicators. There is a recognizable template for breakdown, and Russia is already moving through it. Debt builds, governments overspend, the middle class weakens. Inflation, rising taxes, and unaffordable housing crush stability. Trust fractures. Citizens lose confidence in institutions and leadership. Polarization intensifies. People turn inward, choosing sides instead of collaborating. Elites hedge and leave. Wealthy individuals move capital offshore and withdraw from productive activity, accelerating the decline. Every one of these indicators is red in Russia today. Financial lesson 1. The key to any crisis is spotting the leading signals before they hit your money. Collapse isn't random, it follows a pattern. And if you understand that pattern, you can endure it, even benefit from it. Pillar 1. The energy trap and the China constraint. For decades, Russia's economic strength came from oil and gas. High prices funded schools, pensions, and national programs, but that revenue engine is fading. External restrictions and reduced European demand have created a structural shock. Oil and gas income fell more than 20% in the first 9 months of 2025 versus 2024. Total fossil fuel export revenue is at its lowest since the escalation of the conflict began. With Western buyers unavailable, Russia turned to China and India, but only through steep discounts, often $30–40 below global prices. This isn't a balanced partnership, it's financial dependence. China now influences pricing, routing, and even settlement currencies. Russia is trading long-term economic leverage for immediate liquidity. Gazprom faces a projected $160 billion loss in exports over the next 5 years due to the long-term loss of Europe. Pressure is rising. Russia even sold Arctic energy rights to China because it couldn't develop them independently, exchanging future wealth for short-term survival. Global market consequences. This isn't an isolated issue. It generates 2 global effects: energy supply, instability. Any internal disruption, a pipeline incident, a labor stoppage, or a banking shock, can drive oil prices sharply higher. Dedollarization, acceleration. Russia now settles trade in yuan and rupees instead of dollars. The global position of the US dollar is being challenged quietly but steadily. Financial lesson 2. Commodities are no longer a reliable hedge during geopolitical instability. Prices can spike, collapse, or swing unpredictably. The deeper threat is structural change in how the global system functions. Russia's energy trap is only the starting point. Its fiscal policies, rising debt, and a military-driven economy are about to push the downturn into a faster phase. If this feels distant, it isn't. Global markets react instantly to these shifts. In any collapsing economy, debt becomes the silent force that accelerates the fall. In Russia, debt is more than accounting. It's leverage. The government spends beyond its income, directing massive funds into military activity while households absorb the strain. The military drain. In 2024, Russia allocated an estimated $149 billion to defense, about 7.1% of GDP. In 2025, that climbed to 13.5 trillion rubles, nearly 40% of the total budget. That exceeds combined spending on health, education, and infrastructure. This military-oriented structure redirects productive capacity into arms and equipment, leaving civilian sectors underfunded and weakening. It's a classic signal. When a state prioritizes military objectives over civilian welfare, economic fragility increases and collapse accelerates. Hidden deficits and stagflation risks. Official data often masks the real deficit. Russia's true shortfall is far larger, concealed within reclassified budget items labeled as infrastructure or national projects. The economy faces stagflation, high inflation with stalled growth. The loop is severe. The government issues new money to cover costs, inflation rises, interest rates climb to counter inflation, civilian growth tightens, spending contracts, the deficit widens, the cycle repeats. It's financial toxicity, a textbook collapse mechanism. War bonds and bank exposure. To sustain financing, Russia requires state-owned banks and pension funds to purchase war bonds. Essentially, retirement savings are being channeled into high-risk government debt. If the ruble weakens further, or the state fails to meet obligations, banking stress could erase personal savings overnight. Financial lesson 3. Debt doesn't only damage governments, it hits citizens directly. Investors should monitor debt to GDP ratios globally, because when a major economy buckles under its debt load, markets react instantly. Russia's crisis is a fast-moving warning for all over-leveraged nations. The tax trap and the middle-class squeeze. With oil revenue falling and the budget strained, authorities turn to citizens. More taxes, stricter rules, fewer exemptions. The impact is severe. VAT rises from 20% to 22% in January 2026. Small business thresholds fall from 60 million rubles, 732K, to 10 million, 122K, pulling thousands more firms into higher tax categories. This erosion of the middle class is the moment when the social glue breaks, a feature seen in every collapse. Businesses shut down, consumer spending contracts, stability dissolves, housing becomes inaccessible, savings drain away, resentment spreads. Financial lesson number 4. Governments always target the easiest capital first: savings, small businesses, consumer activity. Protect yourself with tax-advantaged structures, mobile global assets, and diversified holdings. Hidden signals: psychological decline. Financial pressure isn't the only stress point. Trust, morale, and motivation are eroding as well. When citizens lose confidence in their leadership, they withdraw quietly instead of resisting. Corruption normalizes, innovation slows, apathy returns. This is the final domino in the collapse chain. Once trust deteriorates, the economy becomes fragile beyond repair. Russia's debt spiral and middle-class compression aren't distant headlines. They illustrate what happens when debt, taxation, and policy priorities move out of alignment. The system weakens from within, and the social impact is severe. The downturn isn't just numerical. It's visible in people, industries, and global positioning. Capital is leaving. So are citizens. This is systemic decay, the phase where reversals become unlikely. Brain drain and labor shortages. More than 100,000 skilled specialists, programmers, engineers, medical workers, have left in recent years. Hundreds of thousands of working-age men have either relocated or entered military service. The result is critical labor gaps across factories, agriculture, transport, and services. Consider this. No economy can rely solely on military capacity if engineers, doctors, and entrepreneurs needed for civilian sectors are in short supply. Every departure speeds the decline, reducing innovation, output, and tax receipts. Public systems under stress. With roughly 40% of the national budget directed toward defense, core public infrastructure is deteriorating. Hospitals report shortages. Access to medicines tightens. Payments to military personnel are adjusted downward. Corruption spreads. Funds meant for reconstruction in contested regions are often diverted or improperly allocated, leaving citizens absorbing the cost of a future that never materializes. Psychological collapse. The hidden financial risk. Economic breakdown is not purely material. When public trust collapses, corruption embeds itself, and motivation to innovate disappears. A form of societal apathy reemerges. The trust index becomes a measurable forecast of stability. When two-thirds of a population sees others as adversarial and institutional credibility hits historic lows, the economy becomes primed for rapid decline. Financial lesson number 5. For investors, public trust is more than sentiment. It is a leading economic indicator. When trust falls, polarization intensifies, governments increase pressure, and markets become unstable. Global diversification and exposure to resilient companies become essential hedges. The global ripple, de-dollarization, and economic fragmentation. Russia's internal decline isn't occurring in isolation. It fits into a wider global pattern, the fragmentation of the world economy. Sanctions and trade barriers have accelerated the shift toward alternatives to the US dollar. China, India, and other nations are conducting more trade in yuan, rupees, and regional currencies, reducing overall dollar dependence. Why this matters? The US gains enormous advantages from issuing the reserve currency. It supports low borrowing costs and allows large deficits. If more economies succeed in routing around the dollar, your investments, retirement accounts, and portfolio stability face indirect exposure. Financial lesson 6. Geopolitical tension can evolve into currency stress. Your hedge isn't limited to stocks or gold. It includes assets beyond a single currency zone, international blue-chip companies, and holdings with intrinsic value. Russia's labor shortages, fiscal strain, and institutional weakening are signals for global markets, not only domestic concerns. A financial crisis may ignite far from home, but its impact can reach your accounts almost immediately. Russia's contraction is a warning and a blueprint for preparation. The patterns are unmistakable: debt spirals, erosion of the middle class, loss of trust, and systemic decay. History is unforgiving to those who ignore early signs, but it consistently rewards those who act ahead of the curve. The Seneca Cliff explained, "The idea is simple, but essential. Growth unfolds slowly, collapse unfolds quickly. You climb for decades or centuries, but a single misalignment or a chain of systemic failures can push an economy over the edge." Russia is the accelerated demonstration. The US, Europe, and other major economies are not exempt. Understanding the Seneca Cliff helps you anticipate crises instead of reacting to them. 4 pillars of financial protection. Smart investors apply 4 core strategies to preserve and expand wealth during volatility. Don't move everything to cash. Crashes often trigger panic selling, but holding cash during high inflation erodes purchasing power. Focus instead on high-quality, dividend-producing companies that endure volatility. This keeps your capital growing even in turbulent markets. Be cautious with alternatives. Gold and commodities may rise when markets fall, but they don't always outperform long-term. True diversification means owning resilient assets with real demand, not relying solely on metals. Don't try to time the drop. Predicting the exact bottom is nearly impossible. Steady, long-term investing outperforms timing strategies. Build a balanced portfolio designed to withstand any environment rather than chasing short-term waves. Invest during downturns. Market declines create opportunity. Prices reset. By directing capital into strong companies during sell-offs, you position yourself to compound faster when the recovery begins. Cut unnecessary expenses, strengthen income streams, and build an emergency reserve so you can act when opportunities appear. The global hedge, mobility, and diversification. Russia's crisis makes one truth unmistakable: financial risk is global. Currency instability, geopolitical tension, and structural breakdown can affect your investments anywhere. Protect yourself with assets outside a single currency zone. International blue-chip equities, mobile and transferable holdings, and retirement structures insulated from local tax pressure. Financial lesson 7. Your younger self is the strongest safeguard for your future. Planning, diversification, and mobility form the core defense against systemic instability. The final call to action. History repeats. Collapses follow recognizable sequences. The warning signs are visible. In Russia, in global debt escalation, and in declining trust across regions. Your task is straightforward. Monitor global financial indicators, diversify across assets and borders, and build reserves that are mobile and protected. Prepare to invest when opportunity emerges. The next financial shock may not signal its arrival, but a prepared investor doesn't merely endure, they advance. Russia's trajectory is a fast-forward demonstration of a collapse pattern that can strike any over-leveraged system. By understanding it, you gain a preview of what may come, and the strategies to navigate it. The next global wealth transfer is approaching. Skilled investors will position early, using the lessons from Russia's contraction to transform a warning into an advantage. Will you be ready when the market reaches the Seneca cliff, or will your wealth erode while others seize the gains?